We've got a small presentation today. We're going to talk about futures. After this, we will open the bar, so help yourself. It'll be open. We have refreshments coming and appetizers, so hope you stick around, network. The thing about Freight Alley is when we decided to move our headquarters to this particular building, this bar was here. It was known as the World of Beer for those that had ever come in. And the landlord asked, they said, "Do you want us to tear out the bar?" And I said, "No, don't do that." And so one of the things that we thought was that we should turn Freight Alley into an event center for the freight and transportation community in Chattanooga. And we've said this before, this is a place to host events. So if you have an event that you want to host and you're connected to transportation, we'd love to host it here. So really excited that you guys are here, and thank you for coming out. So about 3 years ago, I was day trading unsuccessfully. Like seriously, I lost a lot of money. But I kept seeing, this has been during the commodities crash of 2015 and 16, if you guys remember when commodities were crashing. And on CNBC, they kept popping up the Baltic Exchange and talking about how global maritime rates were a indicator of the global economy. And it really struck me as interesting that they've created financial products based on maritime, but there was nothing for trucking. And having a trucking background and family, I thought, well, that's really interesting. So I flew over, I started doing some research, and I flew over to London and spent about a month there learning about the futures market, the financial markets based on maritime at the Baltic Exchange. The Baltic Index is what it's referred to as, and thought this was a really interesting opportunity to come and create a financial market based on U.S. trucking rates. Because trucking moves 70% of the economy, and it is a bellwether of economic activity. Truckers and people involved in trucking see the movement of the U.S. economy months before anyone else does. And I think if you are in the space, and I know many faces are in the industry, you recognize that you know the pulse of the economy. But there is no, or has not been, a way to actually understand by using a financial product that are common in other commodities to actually understand the direction of the market. So Don Thornton, a dear friend of mine who's recently passed, Ben Murphy, and I've been friends, I've known him for 15 years, had created an index years ago to track trucking and had sold that business off to another company. And we started doing some research on, to create a financial market, you need an index. And we looked and determined that DAT had the best index. And Ben knew Don, which you'll hear from shortly. And he set up a meeting, and Don said, "Yeah, I'll meet you." And he met me in 4 days. I flew out to Phoenix, met him on vacation, I believe. And we talked about the idea of creating a futures market based on trucking. And then after that, we went and talked to some exchanges and talked to folks that that create financial exchanges and run financial exchanges. After a long and extensive process, we came across Nodal Exchange, which you'll hear from Danny here shortly. That is our partner. So those are our partners in the market, and we'll talk about what role each of those have and why they're important. But I really want to thank you guys for coming out, because this has been a long run for us. So a little bit about who Freightways is. When we first started this business, our entire focus was to create a futures market based on trucking. But what we realized is that any successful commodities market also has a news and data business that also services that industry. In order to create financial instruments, you have to empower people who will trade it with data and news. And in trucking, there was no news provider or data provider in freight. And so we went out and created that. There are news providers that a lot of it is print-based, or a lot of it's just if you're buying a new truck, there are great news services that will tell you what engine and what truck to buy. But there was no real news service that could focus on the market as an economy. And we created Freightways, our news outlet, to do that. And then we have also created a data product that also helps provide analytics as to what's happening in the market. I want to make this very clear when we talk about futures, because this is the most common thing that I get asked is, what happens when the truck doesn't show up? There is no truck. There will never be a truck in the financial futures market. They will not exist. If you order a truck, if you trade a future and you think a truck is going to show up, 100% of the time that truck will never, ever, 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 ever show up. It will service fail 100% of the time. There is no physical truck. What we're talking about is an index. We're talking about trading an average of a market. We're not talking about a physical truck showing up. And this is a really important fact that I wanted to make sure that everybody understand. We're not talking about buying trucking services for next week or next month or next year. We're talking about hedging and speculating on the price of trucking services. It's a way to de-risk your exposure. A little bit about the trucking market. The nice thing is being in a city that Steve Case called the Silicon Valley of trucking, that we like to call Freight Alley, and somebody has renamed as Freight Valley, which I thought was sort of cool. I was like, I should have thought of that, but I didn't. But you guys know how big the trucking market is, and you know how important it is to our economy. But to put this in perspective, if you look at markets that have futures, crude oil is a $421 billion industry. The nat gas is $138 billion, and electricity is a $390 billion market. These are huge markets. These are huge numbers. I saw somebody from TVA in here. So you know how substantial and important these sectors of the economy are, and these numbers are really, really, really big. So I was visiting with Chicago Board of Trade, Chicago Merc, and I was visiting and talking about trucking, and the person at the end of the conversation says, I just don't think trucking's a big enough market to support a futures market. I was offended because I'm like, what do? We trade agriculture and forestry and fisheries. And I'm like, well, let me show you where you're at. You're right here at 428 billion, and this is where trucking is at 726 billion. And that was the end of my conversation, because my point is that trucking is nearly twice the size of the, people think of corn futures or wheat futures. We're talking about an industry that's nearly twice the size of it. The energy and oil business and coal business is about 534 billion. We're talking about a business that's 30% bigger than those industries, and there isn't a futures market today based on it. The other thing that we hear when we go out and talk about futures is that truckers are not smart enough or sophisticated enough to understand futures. This is a fairly complicated subject. It's not easy to get. I completely get that. I would argue that many truckers already hedge diesel, and the folks that buy trucking services, people that move product, whether we're talking beverage companies, companies that make potato chips, companies that make food, that produce products, they're buying trucking services, and they also happen to hedge their exposure to their underlying product. If you are making potato chips or you're making soda, you're buying corn futures to de-risk your exposure to corn prices. You're buying and selling futures already. Yet the only part of that cost that you cannot hedge is the transportation services. It's the only piece of that transaction, your cost input, you can't do it. 84% of all goods that are moved through trucks already have futures traded against them. So we're not having to go educate a raw market. Many truckers hedge their diesel prices. All we're doing is taking a new market that has never had futures traded against it and creating a new tradable contract based on these industries. And it's energy, it's ag, it's lumber. Those are industries that already use a substantial amount of trucking services. The other thing I commonly hear is the assumption that many people make is that rail is the primary mode of transit. And I don't know how these people think about that, because railroads are not showing up at the Walmart. There is not a train that pulls up to the Walmart to unload freight. Trucks do the majority of the work. And trucks are the fastest growing part of the freight market. It's an important part to understand just how critical trucking is to the global economy. Also interesting is that trucking is bigger, as we talked about oil. And one of the things that to create a successful futures markets is you have to have a substantial amount of volatility to it. And we'll talk a little bit about that. This past year, for those that are in the industry know this, for those that are not in the industry, I'll share this with you, is that over 40% of the S&P 500, when talking about critical risks and things that are biggest headwinds to their business, talks about transportation cost. Over 40% of the S&P 500 mentioned transportation cost as one of the biggest items of risk that they could not control. So the other thing that you need in any type of futures market is volatility. I go up, and I remember Addison, who's right there, when I first showed him, the questions is, how big is the market? We can answer that. Is it volatile? That is a freaking ugly chart. If you are trying to manage your costs, that is an incredibly volatile chart. And frankly, is more volatile than most commodities out there. It is. It's more volatile than currencies. It's more volatile than oil. It is an incredibly volatile market. A lot of seasonality, but just overall volatility. And so that's why we have a lot of confidence in the direction. So what creates a volatile freight market? It's all about supply and demand. This is Economics 101. Adam Smith would be really proud. It is basically inputs of supply and inputs of demand and basically the imbalance thereof. Christmas trees are only bought one time of the year. That's when the Northwest becomes really hot, right? You guys know that? During the summer, people buy a lot of beer, a lot more beer than they buy in the winter. That creates volatility. There's always a finite number of trucks in the market on a particular day. There's always a finite number of loads. The problem is they never commonly match up. You rarely get a balanced market, and that's what creates supply and demand. When the president tweets about tariffs that may or may not happen, sometimes they do. All of a sudden, every auto manufacturer that's worried about tariffs because the president tweeted that he may put a tariff on automobile imports, they're concerned. They start accelerating parts supplies to make sure they don't have a disruption in the supply chains. That creates unexpected demand. When a hurricane hits Florida or hits North Carolina or Texas, that creates a disruption both in supply and demand. And these are the things that create the volatility, and that's why trucking is an incredibly volatile market. So one of the other things that we get asked quite a bit is, why now? And I always take this as like, what makes you so smart? And why do you think that you can pull this off? And why has this never been done before? And I love this question because I think it goes back to the bones of what we're talking about. Is the reason that this has not been done before is that in order to create a financially, remember, the truck will never show up. Yes? In order to create a financially settled futures market, you have to have an index that people trust. That people say, we know and trust the index. It doesn't have to directly correlate to our spin, but we have to trust that it's a benchmark price. And that is a relatively recent development. And I'm not talking about indexes that are based on long-term rates, which have been around for 2 decades. I'm talking about indexes that provide visibility of what's happening right now over the last week, spot rates. And that was the reason we went to DAT, because they are the benchmark provider of spot rates in the trucking market. They take in 60 billion, there you can hear it, $60 billion of trucking rates, and they provide an index. And that's only been done within the 7 years. And there's nobody in the market that even comes close to having the density of data and a benchmark that can even compare to DAT. And we did a lot of testing to make sure that it would be representative. And that is a recent development. The other thing that you have to have to create the index is you have to have ubiquity of capacity. You have to know where the capacity is at. And with the advent of cell phones, we now have the ability to discover capacity. And then you have to move from on-premise computing to really cloud. People have to share the data. All of this stuff has been done for decades in other markets. It's recently developed in trucking. And probably the most important thing is, we call it the OPEC moment. This is shocking to me. Oil was not traded in futures markets until 1983. I've known oil to always be traded my whole life, but it wasn't until 1983 that they started trading oil futures to help oil speculators and oil drillers and wildcatters de-risk their exposure to drilling a new oil well. And if you think about that, we would not have a fracking industry, we would not have an oil industry if it had not been for the advent of futures. It would not exist. And the reason is because if you could not trade your exposure and you couldn't know where the price was going or de-risk and hedge, why would you trust, if you're going to go credit in oil well, that the Saudi minister or OPEC wouldn't just drop prices? They would, and that's exactly what they did. And so we had the advent of the OPEC moment, and trucking had its OPEC moments last year with the ELD mandate. Government electronic logging devices were our OPEC moment. And that is why the industry woke up to the reality that there is a ton of exposure to trucking spot rates. A truck, and one more time, a truck will never show up, ever. So I'm going to go through this really quick. I think most people in this particular room understand this. Who is exposed to trucking volatility? It's the truckers. It's the folks that spend $150,000 for a new truck, 20, 30, 40,000 for a trailer, that hire the driver. They have a ton of exposure. If prices don't hold up and they've ordered another 100 trucks, that's a ton of risk in their cash flow. If they want to, everybody goes, why doesn't the trucking industry, going to talk about driver shortage, why doesn't the trucking industry just pay these huge salaries and give them, you know, another 20 cents a mile or 50% pay increases to solve it? Because if the economy goes to hell, then they're stuck paying these high salaries and they can never roll them back. And that is why we think futures will actually create more financial certainty for the industry and allow companies to pay more consistent salaries and really what drivers properly deserve. Shippers, the things you buy, the cost of what you buy them is in trucking. In fact, if you go look at Kellogg's and Kraft and these big food shippers, a lot of them last year in 2018 reported that transportation costs were what caused them to miss their earnings. Many of them. You can go back and look. I'm not quoting anything that you wouldn't be able to find in the Wall Street Journal. A lot of companies were exposed to price movement. And of course, freight brokers. There's a ton of you in this room. You have exposure when prices move. You make a lot of money, frankly, in a volatile market. When you're talking about short-term spot market, you make a lot of money. But when you lock in a rate with a shipper and you say, I'm going to honor and charge that rate, and you have to go buy that capacity, if the spot prices have come up and you have a fixed price, you are getting crushed. And this is a way to really de-risk that. So this is really what it comes down to, is what does it take to build a liquid futures market? You need a large and volatile market, which we've talked about. You need a benchmark index, and we believe, and rightfully so, that DAT is the benchmark index. You need an exchange and a clearinghouse, which Nodal will talk about, and then you need data and news and analytics to support the ecosystem of a futures market. So I'm now going to turn this over to Tom. Tom, there you go. The screen's not working for some reason. Okay.
Thank you, Craig. My name is Tom Allen. I am the Vice President of Financial and Trucking Freight Markets, and I'm going to talk to you a bit about how we got to where we are. Craig laid the foundation for why now, the fact that we have such a large market, such a large volatile market, and so in partnering with Nodal and partnering with DAT, we parsed through a ton of data to identify the network of futures contracts that will comprise our offering on March 29th. So in working with Nodal and DAT, you'll hear from Don in a few minutes, DAT basically assess about 18,000 origin and destination pairs. From those 18,000 origin destination pairs, we whittled down the lanes to 7 across 6 very large transportation hub cities. And those cities include Seattle, LA, Dallas, Chicago, Atlanta, and Philadelphia. And the lanes that were selected are highly liquid lanes. In the West, the lanes are Seattle to LA, LA back to Seattle. And from those pairs, we've created a regional index in the West. In the South, we have LA to Dallas, Dallas back to LA. And again, from those lanes, created a Southern index. And in the East, we have the triangle between Chicago and Atlanta, Atlanta to Philly, Philly back to Chicago, creating the Eastern corridor. And from those 3 regional baskets, we have a national average. So We have up to 11 futures contracts, which will be listed and traded on the Nodal Exchange. The rationale behind these contracts, these lanes, are on any given day, about 22% of all freight is moving along these lanes. So these are highly liquid lanes. A lot of loads are being taken into account. And from these lanes, there is a direct correlation to about 84% or so of all freight movement. So highly correlated lanes to the national movement of freight. So that's a little bit underlying why we've selected these lanes and why we're going to launch these contracts on the 29th. A little bit about the futures contract specs themselves, and on your tables there are little flyers that outline the futures contract specs, so please do take a look at them. So, as I said, we have up to 11 contracts based off of the 7 individual lanes and the 3 regional baskets and the national average. Actually, the zip codes associated with all of these cities are also included in the pamphlet too, so please do take a look. These are monthly contracts. The contracts themselves will be tradable out to 16 months. So there's a forward curve of 16 months. They are cash settled contracts, and as Craig said many, many times, a truck will never, ever, ever show up. Again, as futures contracts, futures markets, they settle daily, and they will be settled on a daily basis off of the trading activity that will take place on the Nodal Exchange. The monthly final settlement will be based off of the final DAT average, and DAT produce a price on a daily basis. These prices are published, they're available in our Sonar platform, but these prices will be used over the course of a month to determine the final monthly settlement at the end of the month. The type of truck that's included in these contracts these are dry van. It's line haul rate only, meaning there's no accessorial or fuel charges included in the rate, so it is the rate that's being paid to pick up a truck and move it from a dock. The contract size itself is 1,000 miles, so that is the standard for the contract. And the settlement and the pricing is U.S. dollars percent per mile. So a little bit about the contract specs there. And what I'm going to do is I'm going to turn it over to Don Thornton from DAT, and he's going to talk about what they do. So Don.
So I'm sure most of you, how many in here are brokers and carriers? So mostly brokers in here. We've been in the brokerage business providing a load board called Dial a Truck starting in 1978. And we've grown this marketplace when you didn't even have brokers back in those days to today being a very vibrant market where there's over 20% of the marketplace is being managed by the brokerage industry. And of our customers, we nearly see about 50% of the freight that they move on a daily basis is moved across the DAT network or using a load board to find a truck. That was the foundation for the data. Back in 2002, we believed that companies needed to have good information about what's the rate in a lane. We used to buy that data from a third party, and it was mostly truckload rates that shippers were paying carriers, and that just wasn't working. It wasn't representative of the marketplace that the brokerage industry plays in. So we started collecting data in 2010 and coming up with our own index, and we started with about 35 companies. Today we have 800 companies contributing on a daily basis. We update the rate database 4 times a day, and that is the foundation that we're using for this system. Is we're using the data that's being contributed and used as a benchmark for our customers. So we know it's valid, we know that customers rely on that information, and that's the foundation. The freight marketplace today, just 2018 was a great year. We were doing about 1 million loads a day in our system a day. And today, the numbers come down quite a bit. It's more in the 700 to 750 range in terms of thousands per day, but the market's still vibrant, and we still believe that this this marketplace has a good foundation for the volatility that happens in our industry. So thank you.
What I want to do right now is take you through a little bit of a simulation on how these futures contracts can actually be traded. So what I've pulled up here is a trade simulation program that is built into our FreightWaves Sonar platform. And I just want to take you through a quick use case on how futures could be used to hedge exposure in the volatile freight markets. So to start off with, and Danny will talk about this in a second, but in order to trade these contracts, you have to have a clearing account set up with one of Nodal Exchange's clearing members. And so up in the top part here, what you see is basically account information that a clearing member would set up on behalf of your company and enabling you to trade futures. In the middle part here is our market information, where we have the contracts that are available. So in this simulation, we have available the national average as well as the 3 regional averages. So for purposes of this demonstration, I'm going to select the south lane for demonstration. So what you'll see here is the futures contracts that are available to trade. As down here in the bottom is your position and order management capabilities. So if you're placing orders into the market, you can track them. If you actually trade a futures contract, you can see what your position is, as well as track your profit and loss for any trades that you have made. So in this example, I'm going to take the perspective of a shipper. A shipper in the market is a naturally short capacity. And so in order to protect the shipper from rising rates, in the futures market, what you would want to do is buy futures contracts. You're always going to take an opposite view from what your physical position is in the market, in the financial market. So what I've done is I've selected here the March contract. I can take a look at the, where it's priced at with my Sonar data. Pull up a chart and take a look, and I'll just look at how it's performed over the years. And right now, rates are quite low in the southern region. So for a shipper, it might be a good time to try to lock in these lower rates because you're afraid they're going to rise. So I'm going to buy futures contracts, and in this scenario, I know that I have about 20,000 miles worth of freight that is going to need to be moved. That would equate to 20 futures contracts. So I would want to buy 20 futures contracts. So I would go and place an order into the market. I want to buy 20 futures contracts. Put in my 20, and then I would buy. And so in the upper right-hand corner, you'll see I received a notification that my orders were filled. My positions have been updated down at the bottom, and right here you can see down at the bottom, I'm now what they say long 20 positions, meaning I now own 20 futures contracts or 20,000 miles worth of futures contracts. As I secure my capacity, I would want to unwind my hedge, and I would then go back into the market. I want to now sell 20,000 miles worth of the March contract because that's the contract that I had bought. So I'd go back into the market. I want to place an order. Again, I want to offset my entire position, which would be 20,000 miles worth of contracts. In turn, I would sell it. I get my confirmation up here that I had sold my 20,000 miles worth of futures contracts, and down below, I am now flat, or I have zero position in the market again. So that's just an example from a shipper's perspective of how futures contracts could be used. And so with that, I am now going to turn this over to Danny Gomez from Nodal Exchange.
Thanks, Tom. I'm Danny Gomez. I'm from Nodal Exchange. I'm part of the team that founded the exchange back in 2008. We launched our first contracts in 2009 and have since grown to the second largest power exchange in North America. We were launched by a group of participants, but were later bought by Deutsche Börse, the large German stock exchange, and so now we have part of that larger Deutsche Börse family. Today I just kind of want to talk about, at a high level, how the exchange and the clearinghouse play into this whole picture, and talk about some terms that you'll start to hear here soon. So Nodal Exchange is the exchange. What does the exchange do? It provides a central place for counterparties to come trade. So as a participant in the futures market and you want to trade trucking freight futures, one of the first things you need to do is come to us and register as a participant on the exchange. That requires the application process, and then futures world we call it know your customer, and so we understand what type of business you're doing and why you're looking to join the exchange. And then there's some minimum requirements for joining that are set forth by the regulators. In addition to having an exchange, you also have a clearinghouse. The clearinghouse provides the risk functions. And so in a futures market that's centrally cleared, what you're doing is you're providing each counterparty protection. So historically, when futures or forwards contracts were traded amongst counterparties, you are exposed to that person's performance in the future, right? So if you buy or sell a futures contract directly with another company, and you're hoping that that company is there at the time of that contract expiring. When you have a clear futures exchange, we take away that counterparty risk. And so we do that in a handful of ways. We do it through the collection of daily variation margin, through initial margin, and then also having part of that network FCMs, futures commissions merchants. And Addison can talk directly about that. He left JP Morgan to come work with FreightWaves, so if you have direct questions about any of the stuff, really, myself, Addison, Tom, we all have futures backgrounds, so we can answer any questions. And so when you have a clearinghouse, you have banks who are guaranteeing the participant's business. So I think Tom mentioned that you must secure a clearing account. So the second thing that you need to do after talking to Nodal Exchange is call one of these banks. And we have a list of contacts that you can call to speak to people there and express your interest in opening a futures account. What they do is they actually guarantee the performance of their participants, of their customers. And so it's a layer of protection. So when you have these clearinghouses, not only do you have initial margin, variation margin that's collected daily, but you also have big banks that are guaranteeing the performance. So when you go to one of these FCMs to secure a clearing account, what they're going to ask you, same kind of questions that we're asking is, what is your business? What is your interest in doing futures? Do you have approval, at the highest levels of your organization to this? And do you meet their standards? And so different FCMs have different standards. Some of the banks focus on some of the larger institutions. Some of the smaller FCMs service some of the smaller participants in the marketplace. But step one is just contacting Tom and Addison and finding out who you should contact there. We mentioned these terms, initial and variation margin, just to give you an example. So when you do a trade, a futures trade, not like when you're doing an equities trade, you're not paying the full notional value of the trade. You're posting what is termed initial margin. So say, for instance, that you're buying 10,000 or 10 contracts of next July, and the notional value of that contract or those group of contracts is $20,000. What the clearinghouse is doing is it's looking at the historical volatility of that contract over time, and it's assessing what the likely potential moves are of that contract and how much money would we need to do if the participant wasn't performing and couldn't meet his obligations, and the bank or the clearinghouse had to assume those contracts and manage the liquidation of them. How much money would they need to cover a two-day move? And so what you're really posting is what is called initial margin. So the notional value of the contract may be $20,000, but your initial margin could be around $2,000, say, for these contracts, right? And so what that's doing is that's the capital you post to have the trades on. You're not posting the full value. In addition to posting initial margin at the onset, and that will change over time to the extent that a contract gets more volatile, you post daily variation margin. Daily variation margin is saying, hey, the view of what this contract is going to be in the future went from $1.50 to $1.60. Let's exchange hands between the buyers and sellers so everybody's whole on a day-to-day basis. So you're not getting too far out of sync of where the market is. And so it's these levels of protection that the exchange and the clearinghouse provide to the whole marketplace that allows for more liquidity, more trading opportunities and provides greater depth for the people who are looking to trade, so that you're not worried about who is your counterparty. You're letting the exchange take on that risk. In terms of how you can transact, so Tom highlighted electronic trading. There's other types of trading as well. It's called off exchange. It actually still goes through the exchange, but it just doesn't happen on the live trading screen. And so that takes two forms. They're both called block trading. Block trading through what is termed an OTC broker. OTC broker is different than a 3PL. This is a broker who is just finding a buyer and a seller and matching those two people together and taking a fee for doing that. And so what could happen is you call somebody and say, hey, I want to sell 10,000 lots of next July. And they have a whole bunch of people that they deal with, and they reach out to their pool of customers and say, hey, I've got someone who wants to buy or sell, and then they match up the counterparties and bring it to the exchange for clearing. Additionally, you may have a relationship directly with other participants on the exchange. And instead of using a broker, then you can call that person directly and say, hey, I know that you're typically on the other side or the other direction of the trades I'm trying to put on. Can we do a direct deal? And then you do the deal directly with that counterparty, and then you send it to the exchange for clearing. All of these transactions get sent to the exchange. They're centrally cleared, and they're protected by those layers of protection that I talked about earlier. In addition, in freight waves and Sonar, there'll be data that's happening in the futures market that will come into Sonar. So that includes the DAT data, so the index that we're going to settle to. Futures curves, you heard that term a lot. So that's the market indicating where they see the future price of all those contracts to be. So Nodal Exchange twice daily will use the data that they get from the trades that happen on the exchange, as well as information from the market, to show where the market views that the future of those lanes going. So you may see that rates for next July are, the market thinks that they're going to settle at $2, right? Or they may think that they're going to settle at $1, but that information is being produced by the exchange twice daily and incorporated into Sonar. And then in addition, from Sonar, you'll be able to access Nodal Exchange's trading platform, which is powered by a technology called CQG, which you may be familiar with. They've operated in the futures market for decades now. And so if you have any questions on any of either getting an account, how you can register with Nodal, which FCMs you should be talking to, or any of these transaction methods or any of the terms we talked about today, feel free to reach out to myself as well as Tom and Addison, and we're happy to answer those questions after this or any time in the future. I think now Kyle Lintner from K-Ratio is going to walk through some examples.
Thank you. Hello, my name is Kyle Lintner. I'm a principal at a firm called K-Ratio. We are an NFA member firm, CFTC registered CTA. All those letters mean is that we are legally allowed to provide opinion, advice, and risk management related to futures trading. Personally, I have over 20 years experience in futures trading, the last 15 trading my own account in futures, options, stocks, bonds, currencies, you name it. Additionally, I have been a member of the Chicago Board of Trade since 2006. With that out of the way, I thought we'd dive into what this means specifically. Talking about missed earnings. I know you heard it before, but I'm going to repeat it because it is worth repeating. 40% of S&P 500 companies cited transportation costs as the main reason for decreased profitability in 2018. Simply put, this is a way to limit costs. If you are a private or public company, these losses are not limited to quarters or years. This moves forward. If you're public, we're talking about lower stock and investor confidence. If you're private, we're now decreasing your company's value compounded by the industry multiple that you operate in. This lowers your enterprise value. 2018, we saw an increase of 30% year over year in rates. Contained within that 30% increase were swings of greater than 60%. This is all subject to what's been estimated at 5 to 14% of cost of goods sold, our transportation cost. 5 to 14% subject to 30% increases and swings of volatility of up to 60%. This is not a way to operate a business. To put it in visual terms, this is your 2018 national average, one of the products that will be open for trade on March 29. If you are a shipper, this is a way to lock in your costs and provide estimates moving forward for budgets. We see this peak in June and July. We also see where we're at now down in green. These are the lowest rates since 2017. This is an ideal time to lock in coverage moving forward. On the other side, This is a way to lock in your revenue. If you are a carrier, we take the variability out of it. You now can provide estimates moving forward what your trucks will run for. You can effectively lock in the price that your trucks will run for. Same idea. This is a fiduciary responsibility, and we're just trying to provide correct estimates and proper bottom lines. Same chart, different perspective. Same peak in June, same peak in July. Everyone at that time thought these rates were going to continue moving higher. Everyone thought we'd be at $3, possibly $4. Well, we're all wrong. We're all now down to $1.47. Had this tool been around, this would have been a way to lock in your revenue moving forward. This allows you to operate your business at a higher revenue amount. It also allows you to expand your business if you see fit. Those two are pretty straightforward. This is where it gets a little interesting. We're now talking about fixed operational revenue and fixed carrier expenses. This is for a 3PL. Same idea. We can take your revenue estimates, lock that in, but we can also try and limit your expenses. All the time removing the variability involved with it. Talking about being long and short at the same time. I understand that doesn't make much sense. It sounds like you're delta neutral, or it sounds like something you shouldn't even participate in. Step by step, take the easiest to understand and the most direct. It's a revenue hedge. Just like the carrier, when you're a 3PL, your revenue's tied directly to rates. The higher they are, the bigger margins you have, and you're taking it out of a bigger pie. With this tool, you're able to lock in at higher prices, like the peak of June and July versus where we are now. The twist to all of this comes in the form of limiting your expenses. This is lane specific now. This is a micro level hedge. This is LA to Dallas. This is a way for you to tie your expenses and sourcing capacity to something that relates to your book of business. If you are a 3PL, with overwhelming majority, you are sourcing all of your capacity. Even on your contract business, you're going out to find the trucks. That is spot market price. You are naked and you are unhedged in spot market prices. You can take your current RFPs, tie it to something like LA to Dallas, find the correlations within your lanes, effectively lock in the price that you will be paying for all of your trucks moving forward. This is something that gives you a competitive advantage against everybody else. In addition to 2019's coverage, this is something that you can operate your RFPs in the future, in 2020, in 2021. Those that can take the risk premium that you're already building into your bids and place it in the market in someone else's hands will have a better chance to win those lanes, and then now you can adhere to those lanes. You don't have to worry about losing primary status. You don't have to worry about how many times you can give the loads back because you've already sourced your capacity at a set price. I understand some of these concepts are a little difficult. If you'd like to explore them further, I will be around. You can also visit us at k-ratio.com. In addition to myself, we have an entire team of data scientists, engineers, mathematicians, and statisticians. In addition, we are a subsidiary of a 22-year-old asset and freight brokerage. So we have every angle covered for all of this. With that, I'd like to open it up to questions. I would ask that you wait for one of the microphones floating around to get to you first. No questions? We were that good? I guess we're amazing.
How about a fake question? George, you want to ask for the trucks and
When will the truck arrive?
Tomorrow. No, there is no truck. I know everyone said it, we'll say it again. There is no truck. We are trading the price of that truck, and that is all.
If they want to sign up to trade, what is the process to do that? Do you want to?
Yeah, sure. So, like I said, it all starts with Tom and Addison. The way the partnership's structured, so we are the exchange. We don't pretend to be the experts on the market or on developing the product. So that's Freightway's role. So they're the sales and marketing force behind the Freight Futures launch. They're working closely with us to make sure that you can jump onto the exchange and start to trade. And then we know we had the slide that had the list of FCM. Some of those are banks. And one thing that we encourage as you're looking to get a clearing account, look at that list of banks and FCMs. And if you already have a relationship with them and you're clearing other futures, that's the perfect place to start. If you have a relationship with them on a corporate banking side, that is also a really great place to start. For instance, if you bank Wells for your business, call Wells and say, I want a clearing account, that's a really good place to start. Or you can just start fresh with any of the other ones, but it is membership at the exchange and a clearing account with an FCM.
I have a question. How will this work for the smaller? It seems like this is built around scale. How does this work, Kyle, for the smaller carrier or even the medium-sized ones, maybe downstream a little bit?
Sure. For those that are not eligible to meet the requirements initially from the exchange to set up, there are some other ways to explore participating. The one that's come up most often is the idea of like a co-op. For those of you familiar with agricultural markets, for instance, farmers in Northwest Indiana might not be able to do this on their own. They might not understand how to do it on their own. They'll pool together with each other, and one person will hold the funds and make the trades for those funds, and then spread them down to each account for what that account's needs are. In addition to that, there is a possibility we could have something where there's more of a pool or kind of a similar thing to a co-op, but it's a group gets together and does it on their own. Same type of idea, though. We're going to pool together to meet the requirements, and there will likely be one person who can handle the operational aspect of that risk, and that'll filter down to each account that is lower from it.
So any other questions? Well, yes.
Do you see these futures contracts becoming part of the universe that already established managed futures funds eventually start looking at as part of their portfolio?
Yeah, sure.
And they're on a different exchange. I'm trying to think of how it would work.
I do.
logistically.
I can say that there are a lot of people that are interested in this product that are not directly related to it. They have no underlying business,
Yeah.
but as Craig mentioned earlier, the freight market is a great barometer of the overall economy, and it can really provide insight as to where we're going, whether it's higher or lower. So you could see it from both ends where, yes, conceivably down the road we might have an ETF type situation where those that want to invest in this product can do it from that. There's also the more advanced route. Some of us might think things are a little worse and want to take the bearish approach, and you could have now your short ETFs. But there is a lot of interest in this because of like what's been said. This is a great gauge of everything overall, economy-wise.
And freight is something that every company that produces a product is exposed to, and many of these companies already understand how to de-risk agriculture products or energy products. It's just an extension of what they already do. It is a new concept for trucking, particularly freight brokerages, but many of the sort of mindsets that go into freight brokerages, the trading mindset, not necessarily the structural mindset of how this market works, but the trading mindset is sort of embedded in the freight brokerage industry. So, well, I want to thank, any other questions? The folks that you've met here, let's thank these guys for coming out. Thank you for coming out. We have prepared dinner, or I should say FoodWorks has prepared dinner or apps for you guys, as well as the bar Mariah is now open. So enjoy yourselves. What's that? Oh, we have a raffle. So, okay. I guess I'll do it. So Jill, guess. There you go. You asked a good question. You get all this? We're doing, okay, let's do one. All right. Okay, we'll do one. We've got Seth Fowler. All right. We've got Mike Dietrich and Ryan Dotery. So there we go. All right, guys, enjoy yourselves. Have a good day.